Here's the truth. Most business owners are deducting their vehicle expenses completely wrong. And the IRS is extremely specific about what qualifies and what doesn't, and how you have to document it. Today, I'm going to show you the exact rules for auto deductions, mileage, actual expenses, depreciation, and how to run everything cleanly through your accountable plan, so reimbursements remain 100% tax-free and compliant. Welcome back. Episode 3 of our Accountable Plan mini-series. I'm Mike, CPA, co-founder of Ledgerly. In episode 1, we covered the foundation of the accountable plan. In episode 2, we applied the home office and the Augusta rule. And today, we're going to be talking about one of the most common and misunderstood areas, vehicle deductions and auto deduction strategies. I'll tell you right up front, vehicle deductions are where the IRS expects the highest level of documentation. This is not something you guess on. And here's where most business owners mess up. They pay their auto expenses personally, they deduct the full amount, they don't track the mileage, they mix business and personal use, or they depreciate the car incorrectly in an S-Corporation. The reality is really quite simple. If your documentation isn't airtight, the IRS will disallow the deduction. And with S-Corporations, you can't claim auto deductions personally because the business must reimburse you through the accountable plan. So how do we do it? What's the difference? Miles versus actual. So the mileage method is the standard rate. So for 2025, business mileage is 70 cents per mile on the dollar. So what happens? You track your business miles, you multiply that by the IRS mileage rate. It's 2025 now, so 70 cents a mile. You upload all the mileage to either your spreadsheet or another documentation software to make sure you're tracking your business miles. And then boom, you reimburse yourself for that auto expense through your business. Now, the mileage method includes the depreciation factor. It is the easiest for documentation purposes, and it's the most flexible option for mixed-use vehicles. Now, the actual method, this is where you have to track everything. Your gas, your insurance, your repairs, your maintenance, registration, tires, and depreciation. You would take this, multiply it by your business use percentage, and reimburse yourself. Now, see the image on the whiteboard here. It's very explicit. On the mileage side, personal commuting is not included. It's only the business aspect of the mileage. And then also on the actual side, if you're financing that car, the interest expense is also deductible for the business use. But which one is ultimately better? And it honestly depends on the vehicle. Mileage is simpler. Actual can be more valuable, depending on the mileage on the cars, depending on the repairs, the depreciation. Is there a luxury vehicle tax? Higher business use? It honestly quite depends. This is where you need to do more strategic, in-depth planning offline with your CPA. But be careful. Once you choose one, you're stuck to that one for the entirety of that vehicle. So yes, you can use mileage and actual on two different vehicles, but you can't go back and forth and play a tennis match with the same vehicle. Once you choose one, you're stuck. Now, once you have all your reimbursable expenses reimbursed, where do you put it on your tax return? For your S-Corporation owners, you do not deduct the auto expense on your 1040. Instead, like the home office, it goes on your S-Corporation as reimbursable auto expense under your accountable plan. So you need to make sure you're tracking it in your mileage log or your actual expense report, which again, if you're one of our clients at Ledgerly, we have the Excel spreadsheet for you to actually track these expenses. Then you reimburse yourself tax-free under the accountable plan, and you take that deduction at the S-Corporation level. So enough of my jib-jab. Let's actually get down to the numbers. Let's get down to the business. So let's look at a couple different scenarios here on the whiteboard. We have scenario 1. You drive 8,000 miles in your business in a year. Let's say we're evaluating the mileage method. That's going to be 8,000 miles times 70 cents on the mile, which would be a $5,600 reimbursement. $5,600 tax-free reimbursement. Business gets a tax deduction, and you receive $5,600 tax-free. Now, how about the actual method? Let's say we're evaluating the same vehicle. The actual annual cost are going to be your gas, your insurance, your repairs, your registration, the depreciation allowance, getting you to a total spend of $8,500. Let's say it's 60% business use. 60% times that $8,500 is $5,100 of a reimbursement. So $5,100 versus the $5,600 for the mileage method. For this example, we can see that mileage works better on this vehicle. So if this individual that's evaluating this looks at this, then they're going to take mileage and they're going to be stuck with mileage for that vehicle. So again, it depends. It's kind of like, should I lease a car? Should I buy a car? It honestly all depends on the deal that you get. So Make sure we're doing our due diligence, people. Let's crunch those numbers. Let's look into it, because I'm going to take that 5,600 all day long. Okay, so let's take a step back here. What are our action item steps? Pick one. We gotta have a method. So we have to pick our mileage or our actual. We can't go back and forth, as we said. You have to pick one, and you're stuck with that one for the entire life of that vehicle. Number two, we want to track our documentation. Again, if you're a Ledgerly client, you get a spreadsheet, an accountable plan spreadsheet for the mileage. So we're going to be tracking our dates, our purpose, our miles, if we are doing miles, and also the business use percentage. And again, we can reimburse this monthly, we can do it quarterly, we can do it semi-annually, we can do it annually, but make sure the documentation is there, because again, the $1 million word, documentation. Number three, again, this is all going to live in the accountable plan. So we have our accountable plan on hand, we have it printed, we have it documented, and we have our Excel spreadsheet as our books, as our audit-proof books to document the actual mileage and the actual expenses if we're going the actual method. Number four, we're making sure that our S corporation is reimbursing us personally, getting that tax deduction from the S Corp side, and getting tax-free income that we are not claiming as taxable income. And then number five, this is very important. If we are taking that actual method, remember that depreciation does come into play. So make sure we are looking and tracking different depreciation limits depending on the vehicle that you are using. Again, this is like a 5-minute video, so that goes way more in depth. But if you want that more in-depth explanation and you want to make sure you are running these reimbursements properly through your accountable plan, and you don't know to use mileage or actual, which one should I use? I have no clue what to do. Don't worry, schedule a call with us. We are happy to walk you through what's going to create that extra $500 in your pocket based on this example that we went through. So make sure you get in touch, book a call, and hey, stay tuned for episode 4, because you're not going to want to miss this one. It's the Board of Advisors and the legitimate way to pay your family for advisory work and structure your annual meetings correctly.